All right. Good morning, everyone. Sounds like you guys can hear me. I don't think I can see what I'm doing at the same time. Okay. All looks good. So I'm not going to be able to see your questions as I'm going through because of how. Yeah, John. If something's not clear though, chime in on the audio so I can go look and see what I got to clarify if something technically goes wrong or something like that. But otherwise, welcome. Thank you for joining me this morning. My name is Jeffrey Hirsch, CEO of Hirsch Holdings, Editor-in-Chief of the Stock Traders Almanac, and Chief Market Strategist at Probabilities Fund Management, LLC. We run a 40-Act mutual fund there that empowers a form of seasonal market timing based upon the seasonal timing strategies in the Stock Traders Almanac. And it has a publicly traded ticker symbol, and it's a pretty cool manifestation of the Almanac. So moving right along here, just a little disclaimer, a little word from the lawyers. This is for informational purposes only, not an offer to buy or sell any security. Do your past performance, not a guarantee of future results. Do your own due diligence and consult with your financial professionals. So just a little rundown. I know a lot of people are familiar with the Almanac, but I'm going to just, for those that don't know, last year, the 2017 was our 50th anniversary edition. It was dedicated to my illustrious father, Yale Hirsch, who I just saw yesterday. He's happily installed at the Jewish home at Rockley with my mother. So they're together. He's 94, she's 90, but they're in good hands and doing well. But back in 1966, when I was born, just before I was born, Yale created the Hirsch Organization and the Stock Traders Almanac. Many people have been dabbling in seasonality, cycles, trends, patterns, and that sort of thing. But Yale was the one that put it firmly on the Wall Street map with this iconic handy reference manual, the Stock Traders Almanac. He took all the indicators and put them in a calendar format so that one could follow along with the market's calendar along with themselves. And he developed things and invented things like the January barometer, the Santa Claus rally, the best 6-month switching strategy, not just sell a man, go away, and a host of other quarterly, daily, intraday patterns that we all have had the pleasure of standing on his shoulders to see further. That's why I have this Isaac Newton quote here. I referenced it in the dedication. And so that's what brings us to this place. Here's a little history of 50 years on the street. 68 edition, the first edition over there, the 2018, which is out right now, and several of the other books. Of course, the wonderful title that Yale put out in 86, Don't Sell Stocks on Monday, especially during bear markets. The Almanac Investor book we put out that really put seasonal sector trading in a full framework with ETFs in there. My Super Boom book, The Big Forecast, which I'll go over, which seemed rather incredulous back in 2010, now quite plausible. And the little book of Stock Market Cycles, which is a sort of handy, easy, approachable, sophisticated book for dummies on market cycles. And all the places we get to appear or get quoted, a privilege and an honor all the time that I get picked up and I get to do CNBC and that sort of thing. Always fun. Little trip down memory lane. Yale on Wall Street Week. You'll see the 70s bushy mustache there. Of course, this was after he made that Dow 3420 call, which was the 500% move from the 74 low, which is the same cycle that I made the forecast for Dow 38,820. A picture of me, that's about 15 years ago, with more hair than I have now. As anyone who's seen me, I am becoming more and more like my father in the hairline area. So a little offer for you guys. I think John might put the link up to our subscription service, which you get a free copy of the Almanac every year. You get all of our trade signals for the best and worst 6 months, the best 8 months for the Nasdaq, as well as stock picks, which I'll go over in different sector trades, which, in the monthly Almanac, so what goes on and what's expected to go on with the market on a monthly basis. And I know a lot of you guys are pretty nimble traders. So I know people who do more options and futures find our setups, our trade ideas quite conducive to whatever sort of trading strategy or style that one uses. So again, good deal 150 for 1 year, best deal 250 for 2 years. MTS 18 1 year, MTS 18 2 year, MTS 18 are the code. So feel free to. They should all be set up and working over there to take advantage of it. Our philosophy, the market history are bound to profit from it, is a takeoff on the famous Santayana quote that those who fail to remember the past are condemned to repeat it. Like our friend Stovall says, we like to use history guide as a guide, not as gospel. Also, this quote about history rhyming is apropos. We're not looking for the exact same thing. We're looking for setups here. We've spent the past 50 years analyzing, researching, and testing every single stock market trend imaginable. It's published annually in the Stock Traders Almanac, which Danny's been getting for since NAM, right? And we also update it weekly and monthly in the newsletter. We use it to construct portfolios. We start with our bias in cycles, seasonalities, and recurring patterns, and this is what really adds some juice to our stock picks. We're not just buying or selling or shorting stocks at any time of the year. It's during the seasonally opportune times that seems to add an extra level of outperformance to the stock picking. Look at current trends in the economy, monetary and government policy, always very interesting, especially this year and a midterm election year. We also look at internals and sentiment. I still look at the put-call ratios out of Barron's, even though the lab pages aren't what they used to be. I do like the investors' intelligence numbers, one sort of survey, one sort of actual trade play, as we'd say in Yiddish, took us off in Tish trade, where people are actually putting their money on the table, and old school fundamentals and technical analysis. The major cycles, we'll look at some of these here today, just to update you as to where we're at. War and peace in the secular bull and bear market. That's the basis for the super boom forecast, the 4-year presidential election stock market cycle. The midterm election year is rather relevant this year with what's going on. And the seasonal cycles, the best and worst 6 months, our bread and butter and different sector and commodity trades. There's a few of them, which I think you guys would be, interested in, that come around on the calendar this time of year. And some of the quarterly, monthly, weekly, daily, and intraday trading patterns. I'm not going to get too into the weekly, daily, and intraday stuff, but if anyone's got an almanac, I encourage you. This works despite all the high-frequency trading and algo trading, still rather consistently. In the back of the book on pages 139 and 140, the intraday half-hourly trading patterns, which is one of the first things I really did calculation-wise for Yale back when I was a kid, using the Barron's lab pages and a ruler and a red pen and an adding machine. Now we have it, of course, on the computer, and we run the numbers. And you'll see the consistency of intraday trades. I think it's something I know a lot of you guys day trade that you'll find relevant. Let me just check back. I see here's some beeping over there. Is the sound working okay? Did somebody not have theirs on? All right, we're good. Thanks, John. And the January indicators, very relevant this year, despite the carnage that we went through. So we'll look at that to the present year. So just a little flash in the recent past, a reminder to everyone to read your own analyses and publications and writing. This was brought to my attention by a subscriber who I was chatting on the phone. And this is from the 2011 Stock Traders Almanac that came out, as you can see, went to press on May of, I don't know if you can see my pointer here, May of 2010. We had been tracking this pattern that Yale had come up with, discovered in 76. As we went into the, 9/11 sell-off and 2002 in Afghanistan, and then back situation in 03, and then again with the real sell-off there at the Great Recession and the bear market there in 2009. And then in 2010, it looked like this pattern had presented itself. And you can see, interestingly, uh, somewhat prescient that the last four words of this article before the footnote is the next super boom 2017, and I think we've seen that come quite a ways, and I'll show you what that looks like on the big chart. But basically, from the bottom in 74, it took 8 years before the market took off in 82. The rest of that 500% move that Yale was talking about, based upon market moves that you see in the bigger chart after war and inflation. So we did the similar math from the intraday low of 64.70 on March 6th. We put the Dow at 38,820 in the year 2025, and I think we're on track with that than we have been in a while, despite some recent action. So here's the big long-term pattern to give you an idea of where we are in the market. World War I, you can see a lot of people will try to pigeonhole cycles into specific time frames, the 17 and a half year, the 18 year, the 16 year, 20, whatever it is. But in reality, things are triggered by events, and you can see in 1914, the Archduke is assassinated. Germany signs the armistice at the end of that secular bear market around World War I. The CPI goes up, inflation rises 100%, and then the Dow rallies over 500%. Again, the secular bear around World War II. Germany invades Poland in 39. Japan surrenders. CPI goes up 74%. After the war, you see the 500% move in the Dow up to the 60s, nifty 50s and the 60s top there. And then we have the Gulf of Tonkin resolution, the beginning of Vietnam, Saigon falling, and then you see circular. This is our 1982 period. There's much debate on when the secular bull or bear markets begin, and everyone is pretty much convinced that the last secular bear market ended on August of 82. And that was the beginning of the secular boom, bull market there, not in 74. So for people to claim that the current time around, that 2009 was the beginning of the secular bull market, is not necessarily the case. We feel that was the low. Recent bear market, the Ned Davis Research defined bear market in February of 2016, was our 1982 moment. And we can see inflation not quite cooperating as much. There are several factors that also come into play with this. Functional government, like Gingrich and Clinton, warts and all, were able to do some things. Tip O'Neill and Reagan have to get out of this armed conflict, and inflation ticks up. And also something that I call, which is also in the 18 Almanac, the culturally enabling paradigm shifting technology. Yes, that's a mouthful. Things like the automobile and the television and the microprocessor and those sorts of things. Indoor plumbing, the combustion engine, things that really changed the world and touched everybody. Moving along with this long-term outlook, we put out that book, the Super Boom Forecast, in March, April 2011. After we made this forecast in 2010, Wiley asked me to put together some projection promotional things. So I drew this blue line. You can see the 2011 forecast in blue. The black line is the actual monthly Dow closes. This is as of 2/8 when I last updated this a week or so ago. And then we updated this forecast in 2017. And what I did back in the day was I took all the Almanac seasonal patterns, 4-year cycles, secular, cyclical, bulls and bears, and dialed up a lot of Yale Hirsch and some George Lindsay, if anybody remembers that. Bit of Ned Davis Research, the Markets in Motion book, which I love. And I sort of plotted out what I thought might happen with respect to cycles and patterns looking forward. And I put this blue line in there. Then we had operations, QEs 1 through 3, and Operation Twist and that sort of thing. And we ended up raising the floor on this a few times. The latest iteration was in March of 2017. We'll be updating this again. I don't expect this type of bear market here that's depicted here by this red line in 2018 where the circle is. I think we get some of a pullback. I think we've had a similar, we did have this sort of dip here 18, a little bit more pronounced than, but I suspect we'll have some sort of corrective phase in the May to October period in the midterm year, but then we'll continue on our pace. We've got a bear market in our future. It could be one of those 19% jobs. It could be 20 to 30%. I think probably in the lower end of things. I'm not doom and gloomer here. I think we've had our doom and gloom back in '09, and I think we're due for something more garden variety, despite the fear and carnage for the recent volatility. So let's just look at where we were at last year. My forecast, a little bit conservative, but basically, in the base case area, we had some moderate success and some decent double-digit gains. I think we got the tax reform at the end, and some trimming of regulations that helped the market, but we didn't quite get the healthcare or the infrastructure build out, and there's still a lot of, I guess I'll dial up Yiddish again, a lot of mishigas surrounding the current administration and what's going on in Washington right now. But things seem to be pleasing Wall Street. So that's just what we had put out in the end of 2016. And let's look at the 4-year cycle here. You can see the midterm year, usually one of the weaker years. 2015 was the first Dow loss in a pre-election year since Germany invaded Poland in 1939, but we still see most of that strength in the third year, which adds to the sort of midterm year being the bottom picker's paradise. Election years have taken it on the chin quite a bit, especially 2000, 2008. But that's the 4-year cycle as it lays out. Let's look a little bit closer at this particular presidency and the midterm year. This is a chart we put out in the beginning. This is looking at the political alignments versus all years. Republican president and Republican Congress has had average gains of 14.1% in every year that political alignment was in place, not just just post-election years. For what it's worth, a Democratic president and Republican Congress is up over 16%. It seems like corporate America is quite pleased with the new tax law and less regulations across the board. I think, despite normal garden variety corrections, I think pleased with what's going on. Not everyone is though, but the market has been telling us that it's happy, and that's the definition or the poll that I watch. So the midterm election year sweet spot, bottom picker's paradise here. We've laid out the different quarters by election year and the 3 major indices. You can see this week period in orange from Q2 to Q3 in the midterm year, which is sort of what we're approaching on now. And then this real powerful day from the 4th quarter of the midterm year to the first 2 quarters of the pre-election year, cumulatively averaging, about 20% for the Dow, 21% for the S&P, and 32% for the Nasdaq. So if we get that kind of, worst 6 months correction, that the cycles and the patterns line up to present, it should be a nice trade for the upside. And that creates this 50% move, or just about 50% move off the midterm low. A couple of interesting things here that I've highlighted. You see a lot of these lows in January. We almost had, and then October is the other major cluster of midterm lows. And on the flip side, the pre-election year high, again, a lot of them, the bulk of them in December and on the last trading day. So again, if we see some softness in the summer months, as we often do, probably set up a nice opportunity for an upside trade into the middle of 2019. As we entered 2018, there was the question on everyone's mind about, was the big gains in post-election year stealing from the midterm year? So we analyzed that pretty simply with these, 1-year seasonal patterns we like to look at. So you've got all midterm years in the blue line, similar pattern for midterm years after positive post-election years, maybe a little bit more pronounced correction from the mid-April to late September, early October. What's that, 6-7% or so? And just to remind us, you see this January. There it is, just historically showing up, and we had that, so shifted forward a couple of days, and we had a little late January peak this year and an early February sell off in that break. So all things being considered, despite the nerve wracking nature of sell off, I think it was rather normal, expected, and much more orderly than anything we've seen in like in '87 or that sort of thing. So as we sat last year, last December, just before Christmas, that Thursday when we put out our annual forecast, and looking at a part scenario worst based and a low percentage chance to full-blown midterm bear market caused by something unsavory, political front, or some. And then we sort of split the difference for the worst case, the best case and the base case. I hear somebody beeping over there. Is anyone's audio cutting out, or is it just me? I'm just going to pause for a second. I'm seeing cut out for a second. I hope this thing doesn't crumble on me, but you can hear me now? Okay. Oh. All right. Yeah, just chime in if it's there's an issue, and I'll stop and slow down. So for some reasons that I'll get into momentarily, and some other subsequent reasons when we made this forecast, the above average midterm year gains quite in the cards. Perhaps a mild or 6 months correction or pullback. We got most of the 8% for the sell off. And then there's a chance that if everything pans out and tax reform juices earnings and bonuses and paychecks grow and the economy grows and capex picks up, that we could see that the Dow 29,000, S&P 3,300, and 9,800 in the cards. That's not to say that it's going to happen this year, but it could be the level we reach before this particular bull market is over, and I will show you where we get that from. This is from the back of your trusty, handy Stock Traders Almanac, pages 130, I think, if memory serves. That one here, 131 and 132. Bull and bear markets for the Dow since 1900, the S&P since 1930, and the Nasdaq since 71. And we deem two bear markets. The 7 was a Davis Research defined low, which we use. A 13% decline in the Dow over 145 calendar days, peak to trough. Same thing happened in February 2016. So the average bull market, using those rules, is 85.6% gain for the Dow, 81.5 for the S&P, and 9.7 for the Nasdaq. Put that on top of the closing prices of the indices on the last low, 1560 for the Dow, 1829 for the S&P, and 4266 or 7 for the Nasdaq. Gets us 9,000, S&P 3,300. That's the simple math on why those numbers are potentially in the cards. Just want to give you a look at some of the things that we put out monthly in the newsletter. This is part of our analysis that supports the outlook of the forecast we had there. So we look at 5 basic disciplines: psychological, fundamental, technical, monetary, and government policy, and seasonal, of course. So currently in the seasonally bullish period, but remember, February's the weak link in the worst 6 months, tends to consolidate or sell off big January gains, which we've seen. Monetary policy, is sort of scaring people a little bit. I'm not sure what a quarter point can do down at these horrible, historically low levels. But there's a quieter Fed chair there. We haven't heard a lot from him, and I think that may be spooking people a little bit. The market does like to test new Feds, new Fed chairs. I'm to understand from some other inside sources that while he voted the same way, and he'll probably will carry out the policy similarly to Yellen, he's not, Mr. Powell is not as into the transparency as the previous two Fed chairs. So that might give people a little concern that they don't know exactly what's going on. We're overbought back here in January. We fixed that situation, but fundamentally the market looks pretty strong. The economy looks pretty strong. There was a little, a little dip in the GDP, but I think that was seasonal and probably had the impact of the hurricanes and the fires and all that, force majeure stuff that took place in the third, early fourth quarter of last year. But all is better when we have a positive January barometer. And every year, which we did this year, we had a up Santa Claus rally, an up first 5 days, and an up January barometer. In all the years since 1950, we've had that. We've had 27 of 29 years up with an average gain of 17.9. Last 11 months up, 26 of the non-times, only 3 down, and 11, that bear market that I mentioned, 87 the crash, and 66, which was war Vietnam related when they ramped up troops and bombed Hanoi and all that stuff. So for the most part, this is sort of where we stand on Yale's shoulders. He created the January barometer and the Santa Claus rally, which is the last 5 days of the year and the first of the new year, first 5 days of the year. And what we found is even more efficacy from combining the three of them. And that's one of the reasons why we remain bullish this year, that the market was so strong at the end of the year, at the beginning of the year, and for the whole month of January, despite the sell-off that we had. So this is graphic representation of that. You can see the sell-off in 2018, but a look at all years since 1950, all midterm years, and then all trifecta midterm years. So we have a little bit of a soft patch potentially here in May through October, and this is all 29 of those years you saw on the previous page. Well, for the most part, you're looking at the potential for a much stronger midterm year based upon the performance you've seen in January, which is a result of what the market feels about the fundamentals and the situation in the country and around the world. So supporting our bullish forecast, and again, seasonals are doing exactly what they, or not exactly, but mostly what they normally do with weakness here in February. So here's the volatility that we recently got into, and we're talking about real volatility, not necessarily implied volatility, actual daily swings in the market. This is from back in February 9th, and what we were seeing here was this channel that navigator. Now we started it just after the election rally back in November 2016. We had that pop after the election, and things sort of leveled off. So we start there, after that rally, and we were trading once the the celebration of the election rally, sort of stalled for a second there. So you can see, for most of 17, we're trading inside this uptrend channel, below, a little bit above, mostly on the upper end of it. And then as we get into January 2018, we blast right through the top of it. I mean, it's kind of like a pivot point resistance level as well, way above the channel. And then we returned to the bottom of the channel, and we didn't put this chart in here. I got another chart. I'll have to switch back to Trade Navigator. And we bounced right off the 200-day moving average, and we've come back up into that. So let's see if I have that chart in there. That's the other thing there. So before I show you this W123 thing here that you saw, we can look at it together. I just want to remind you about the December closing low. This is one of those things. Lucian Hooper was an old writer. He put this out there. If the Dow closes below its closing December low in the first quarter, watch out. So we found that the January barometer is a little bit more effective, but you can see that there's only there's 3 years here that these are the years where the January barometer was positive, and we didn't get we didn't get a negative year here on the just at 52. We have the full year change day before 66. We had the loss. That's a midterm year, and we had no change in 1996. It didn't go any lower, or 2006. So we crossed that December closing low this year, and I don't believe we've gone any lower than we did on that day. So let's just look. I'm going to switch over to I have to share something different. I just want to show you guys this chart. Are you able to see this? Oh, I got to change what I'm showing, right? Hey, John, how can I switch what I'm sharing? Stop and start again? Oh, I guess I can just copy and paste it in there. Uh-oh, that's not good. I want to share my whole screen, huh? Here with, I'm going to bring a chart in for you guys. Hey, that work? Okay, thanks, John. So this is the S&P. It's even better on the E-minis, but I don't want to take too much time here. So this is a little W123 swing bottom that I thought would be a good level. And this horizontal line is sort of the intraday high and that Wednesday before the sell-off. And we cleared it, but today we're struggling to stay above it. So I think that's a key level for us. Also ends up being right at the low end of the pivot point resistance there. It should be pivot point support, which has now become kind of resistance. So that it's right at the 50-day as well. So I think that's a key level for us here in the sort of short-term technical area. If you look at the E-minis, which I did over here. It's even closer because the intraday lows on what was that? The Tuesday, the 6th and the 9th were more even. Let me grab this one for you. I think it'll be. I'm just going to replace that chart with the E-minis, and you'll see what I'm talking about here. Did that show up in there? You guys got that? Oh, thank you, John. You can see the intraday lows here on the 3 are much more level, which is a better swing bottom for you. So today we were down. What are we at there today? About 2,700. We came back. We bounced right off it again. So that's always healthy. So we're looking to clear that 50-day that level right there. So That's what we're looking at technically with this volatility. So let's jump into the seasonal period here. Just took a call from somebody who, before I got on, was interested in taking out our service, and really only wants the best 6 month signals. Not the only guy that does that, but I think there's a lot more there to offer. So this is the seasonal pattern at sorry, I have a little technical issue there. Yale discovered back in 1986. It was first published in the 87 Almanac, and we like to look at things over different time frames to confirm the continuation of existing seasonal patterns. So we've got, and also, we get a lot of every year, less these days, people try to refute certain things that are in existence, and this also has been proven by the evidence-based technical analysis using the scientific method. But if you look, people will go back to 1896 when the Dow started and try to tell you that the best 6 months doesn't work. So we split the years in three different categories. Before, World War II, basically, or 1950, back in the red line from 1801 to 1949, the black line since 1950, and then the green line since the 87 crash, when things changed. So you can see somebody's beeping me there. Thank you, sir. So you can see the consistency between the since 88 and since 1950, but back in 1901, it's pretty much buy in May. And the reason why we separate here is a different world, a different economy. It's an agrarian economy where most of the cash flow in the economy came out of the farming and agricultural business. So starting in the spring, people were buying, equipment and fertilizer and seed and fuel and hiring people and really working the land. And then that money would continue to flow into the economy until, harvest time, or the market would anticipate it a little bit. That's when you had an entirely different seasonal trade. But now that we have the, similar to the London season, the, financial season from September, October through April, May, when schools get out, we have that vacation sort of summer mentality from Memorial Day to Labor Day, where volume dries up and people spend more time outside and away from trading desks, golf, camps, kids doing stuff for the kids, vacations, going to the beach, sort of thing. You have this tendency for the market to be a bit weaker. Looking at this, just a sort of vacuum black box system, which we had David Aronson at Baruch, who's also a CMT guy. When we picked his book, Evidence-Based Technical Analysis, as the best book of 2008, we had him run the best 6 months switching strategy through the scientific method to disprove the null hypothesis that the results were not the result of chance and it did have predictive power, which it did, unlike the other 6,000 plus black box systems that he tested in the book. So the average gain in the best months, November to April, 7.1%, a slight loss May to October, and just a hypothetical $10,000, one-time $10,000 investment compounding in the worst months gains $843,000 versus a loss of $116 in the 6 months May through October. Use our simple MACD timing indicator, and I'll show you the MACDs we use in a second. Increases the returns to 8.9% and expands the loss to minus 1.6, and almost triples the results of that same 10,000 to $2.5 million versus a loss of about $6,600. So a little seasonality, a little timing, improve our results, and this is the MACDs. This one's a couple of weeks old, a week or so old, but we're still back up around here, slightly positive from our buy signal, which was late this year, and I'll tell you why it was late. We look at the 817.9 for the buy side, the 1226.9 for the sell side. This comes out of Jerry Appel's initial research. I know some people are using like a 619 for the buy now or something like that, which is some of the more current stuff that Appel, Marvin is using over there. But the basic gist of it is that for the buy signal, you're looking for a faster, shorter MACD. These are daily MACDs. because bottoms are more of an event and kind of happen quickly. Tops are more of a process. We use a slower, a longer MACD, the 1226, to keep us in longer and sort of stay in with those longer topping processes that are there. So we did pretty well with our buy signal and sell signal back in October 24th to May 17th of last year. But the market rallied on. We did miss a few things. If you're going to trade the seasonals, you might miss a few upside moves. It's not the only thing that we do. We don't sell in May and go away. We do trade some of the major indices this way, but we do hang on to winning stocks and ETFs, sector trades that continue to go up and not just dump everything. So looking on the Nasdaq version, the best 8 months, staying in a little bit longer because we see an 8-month seasonality where Nasdaq goes until June. Captured about 17%, left a little bit on the table there from June to November. And the reason we got in late was we were having some conflicts between the different MACD buys on the 3 different indices, as well as the difference between the MACD sell. We don't want a sell signal while we're getting a buy signal at the same time, and we want the 3 indices to agree, and that's proven effective over the years. Last year, it did keep us out a little bit longer than we would have liked in hindsight. But this is not to be, this best 6 months is not to be feared because of the great worst 6 months. Another one of the, questions out there was, when you have a really great worst 6 months, does it take away from the best 6 months? We found that not to be the case. We highlighted the post-election years here that had solid, in addition to the other years that had a greater than 5% worst 6-month performance. You can see, what the year-to-date gains were on October 31st, and then how the next best 6 months did. Only 2, minor losses in 89 and 93, but following the full years, we're up pretty substantially, including 2017 now, and then the next year, which would be this year, still up pretty solidly, following this great worst 6 months. So gains beget gains is sort of the mantra there. So our strategy, the big thing that anyone asks me, what's the one thing you tell people? And it's sell your losers short, let your winners ride. You got to go against human emotion. Emotion is our worst enemy. You don't want to be sticking in losing trades. You want to get out quickly. I know you guys are always preaching stops, whether they be mental or hard. And, we do sell some things. As I said, we don't go away. We will go long stocks starting around, August, September, October, short, more like late June, July, once we see the market top there. We do work the different seasonal patterns for ETFs and other indices. There's other tools that we use. I think advanced decline lines and other technical indicators can help you in addition to MACD. And of course, you guys can set up your own options and leverage trades. I know there's a famous trade, not famous, but a great trade that my buddy John Person, who did the Commodity Traders Almanac with us, and we are working on putting out another version of that. One of his trades back in, I think it was 2012, I was down there working on the 2013 Almanac with him, and he was showing me the Russell 2000, making new highs back there in April, and the Russell 2000 advanced decline line going the other way in a downtrend. So he put on a vertical bull call spread on the TZ, is it TZX? The small cap ETF. Do you know which one that is? The TZA, the one that's the Russell small cap. And it was trading at about 14, 15. He bought a 16, sold an 18 for the May expiration. Russell cracked, fell over, he covered it. I think it was about an 80% gain in that trade. So just an example of the kind of options or futures trade that you can implement, looking at the seasonal patterns and the seasonal trade setups, whether it be the S&P, Nasdaq, Russell, or any other commodity or stock or sector. So just a little note from one of our subscribers, and Richard Canfield always seems to do well with this. He took back in 2015. He called me up and thanked us for the best and worst 8-month signals. So people were complaining. He was telling me to him much in 2015, but he had taken $1.5 million in his retirement fund from money market into the QQQs in October 2014 from our buy signal, and then sold it in June of 2015 for an 11% return. And he did it every year, but he mentioned it again in October of 2016. That's a typo there. Sorry about that. He got our buy signal at 119 and the sell signal 139 is 17% return, the 340,000 gain in just his IRA. So this is one of the ways that people tend to use our service for their types of investments, in addition to the different trades that we do present. And I will go over some of those here. So the sector seasonality, see most of the bullish. This is right out of page 92 of the Stock Traders Almanac, and then you'll see a couple of graphic, 2 even pages, 94, 96. Big cluster of seasonal sector bullish periods starting in October, but now we're here in January, February. We've got a couple. You see the utilities long is an interesting trade that tends to work there. There's a computer tech short that's on right now, but getting into the May period, there's a couple of sectors that have some sizable shortable seasonal patterns. Banking, gold and silver. There's also a little short right now that I can tell you about in gold and silver, which comes out of this is the stocks, and then there's a commodity one, which we're looking at right now. Materials is a pretty pronounced long and short seasonality, and I'll show you how that works in just a second. So we like to compare, different time frames, recent, a little bit longer, a little bit further back, to make sure that the pattern is still in existence over the longer haul and still in the short term. Don't put a lot of weight on the 5-year results, but just keeping track of it and seeing what's going on, so we're not blind going into these things. So here's a look at the materials sector. You see a nice bullish period from October through May, bearish from May through October, very pronounced worst 6 months type of trade. And just to show you the comparison of either going long the best months for materials and short the worst months versus buy and hold, average 15% return rotating long and short versus buy and hold 5.3. That same $10,000 example going back to 1990 gains 378,000 versus about 40,000 in buy and hold. So the benefits of being long and short the seasonal trades for materials and other sectors. So energy stocks just got stopped out of this, but I wanted to show you the setup here. You can see the seasonal trade this is the oil index, this is the Exxons and those types of stocks. Also lines up with the sort of February low in energy prices, and you can see we had a little bit of a setup here in December. We had a nice rally, but with all the other stocks, this came down through our stop on that. Copper, pretty consistent December trade. When the market, the construction market's at a low, copper tends to hit its December low period. There's a couple of stocks that we trade based on this, but the correlated ETFs here, the JJC, which is the ETN, of course, you guys will trade the futures, some of you straight up, and the copper miners in the orange, the COPX, correlates rather closely with the copper future. And once we get to later, I'll have the slide list there of the stock list. There's Southern Copper and Global Brass and Copper Holdings, SCCO and BRSS, are 2 stocks that trade very well with this seasonal trade. And we've held those winners for quite a while in our portfolios. So natural gas, got a little setup there. We're looking at the UNG for our sort of stock ETF type trading subscribers, and the First Trust gas producers. A nice sell off here in February, setting up that seasonal trade very well. So that is something that's on our list right now, and I'll show you the updated portfolios in a second once I get through a couple more slides here. So gold and silver enters a short period here in February. It's tends to trend lower through June. You see the other trades out there sort of after the holiday gold buying and the Valentine's gold buying ahead of the Indian wedding season. I think is what some of the rationale is for that. But you can see we set up quite nicely over here in late January with a run in the gold, and the DZZ, which is the inverse gold, made a nice bottom there right around our buy limit of about $5, I think. And we'll just look at that on the table in a second there. So here's our current ETF portfolio. The gold I'll show you on our website once we get there. But this has gotten cleaned out a little bit. This was from the 17th, and we'll talk about the stocks, and then we'll wrap it up, and I'll open up for questions. So our seasonal overlay is sort of the big thing that we add. One of the big things we look to go long in October, short in the summer. But we run a pretty robust fundamental stock screen using Zacks Research Wizard, looking for revenue growth and acceleration, earnings growth and acceleration. We're looking for good valuations, margins, PEs, price to sales, cash flows, debt, and different ratings. And the thing with ratings is we're looking for stock that, all things being equal, with a good, accelerating growth company with good valuations, is if both stocks are very similar, but one of them is followed by 20 wirehouses. We're going to take the one that's followed by a small amount of them, so that when our screen is starting to discover gets picked up by the street, and more people get in it, we get in there ahead of it. So it's kind of like a pre-can slim type of thing for anyone that's familiar with that. And we do use IBD's Market Smith to sort of compare some of our research to others and run it through the Bill O'Neill fundamental analysis to see what else is there. They've got some good data in there. We break it up into 3 market caps. Under $1 billion is small cap, 1 to 5 is mid cap, and over $5 billion is large cap for us. And of course, on the short side, we invert that and look for deceleration and overvaluations and stocks breaking down. We're looking at old school technical analysis once we start buy limits and sifting through the final part of the list, looking for strength and solid chart patterns when something that's not way ahead of the market and that's not lagging it, and for a buy limit an entry or exit point, respect to what's going on in the chart. So here's the basket we put out in October, just to give you an idea of the kinds of stocks that came through that were passing through our criteria. With hindsight being 2020, I'll just have bought these on that day instead of looking at buy limits. But over the long haul, it would have been better to just pick it right up on that day. So you can see some interesting stocks there down at the bottom, some construction and home builders, Boeing's, and some interesting tech and cloud and internet related products companies in the mid cap list, and a couple of small caps there. So this is what the list looked like in mid-January when everything was up and well. We've also got our free lunch stocks in here, which is something you can check out in the page 112 of the Stock Traders Almanac. And then I'm gonna jump over to the website in a second and take some questions and show you what's happened since this out there, just an idea of how things have been updated. So all this research and all this activity through our screening and technical analysis of stocks has since inception in July 2001 has given this list a gain of 400 and almost 59% versus 200% roughly for the Russell 2000 and about 118 for the S&P 500. So some considerable outperformance from our stock picks versus the S&P and the Russell, and showing that seasonality works in conjunction with fundamentals and technicals. So there's the offer for you. I think How's that? Yep, you got it now? Oh boy. Okay, great. Thank you guys. So, questions? I'm here. If anything anybody wants to know about, you can chime in now. Is there audio? Does your research cover UK and European markets? Not so much. We look at what's going on over the world, but I've done some research on seasonals and other markets, but not an extensive amount. Is that something, it's something we're waiting to see if there are enough people that will, take us up on that. So we're working on that. How have things changed in the S&P futures started trading in the 1980s? Larry Williams, just to answer Larry Williams' question there, yeah, Larry is a good friend, and we do think similarly. I think the big thing that we had since the futures started trading in the 80s is triple witching. I mean, we've got this quarterly action that puts a lot of, increases a lot of trading volume, and has the potential for volatility there. We like to use it. We found that trading around triple witching in December and March is much better, whereas around June and September, much weaker, especially the week after. And we had short trade on for probabilities fund during Brexit, just out of the Brexit vote back in 2016. And my partner Joe Childress over there called us up, and he's, it's an ETF strategist. We're long and short and or leveraged the S&Ps or the big cap indices on any given day. We were short going into Brexit because it was the week after June triple witching and a season week period. So we ran a make on all these different one-off events and found that sticking to the system was the prudent course of action. So we stayed short after triple witching, and Brexit went the other way, and we had a nice trade that day. Good question, kid. Who's Chris? So yeah, similar to what Larry Williams did, he put a nice endorsement on my Super Boom book, and I knew Larry when I was a kid too, so learned a bit from each other, and he's a big proponent and helpful in creating the Almanac, and just a good friend for years. So I think I need to relinquish the floor. Is that true? Can you hear me? Oh, you got it. Thanks, John. All right, you know where to reach me. We're on the internet. Appreciate it, guys. You can also do a free trial to our service if you want to check out some of the current trades that we're looking at there. So have a good open house.